Hello, everyone. Welcome to Demand Supply Trading Practical Session number 23 for the year 2025. Myself, Surjit Kakkar, and today is Sunday, 8th of June 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you, we keep updating you with stuff related to demand supply trading. So in case you've still not joined this channel and you wish to join it, there are a few different ways you can do it. First way is you can scan the QR code which is on your screen, and by scanning that QR code you can be part of this channel. Second, if you go to the description, you'll be able to find the direct link. You can click on that link and join the channel. And thirdly, once you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So once you're on our website, you can just scroll down on any of the pages to the footer section, and that is where you'll find this option that join the Telegram channel and join the button now. So once you click this join now button, you'll be able to join the Telegram channel. Now, like I said, on this channel, we keep updating you regarding stuff related to demand supply trading methodology, or if we have any promotions coming up. Plus, the schedule for these live sessions, we also update there so that you know in advance when these live sessions will be happening, so that you're available to participate in these sessions. All right, so today's session is a practical application of demand supply methodology. So once you go through our demand supply course, you basically learn the methodology theoretically. But unless and until you see some practical examples, at times it's not very easy to understand how to implement it. And that is what we do in these weekly practical sessions. Now, the best part about these practical sessions is that we are not looking into something which has already happened, because like I always say, a move which has already happened, it's very easy to justify it. You can use a number of indicators, oscillators, and you can justify why you could have participated in that particular move. But the real challenge is when you need to do the analysis in advance, and that is what we do, and that is what demand supply is also all about. We pre-plan the areas where we would like to be buyers and sellers, and when the prices, they revisit those areas of demand and supply sometime in the future, that is the time those trades, they get triggered. And just because I'm doing the analysis in advance does not mean that I share the analysis with you and then we forget about it. Whatever analysis we do, wherever they get triggered in the future, the very next session, we also review them. And that helps you see both the before as well as the after. And that helps you build confidence in the methodology. All right. So to be comfortable with these sessions, there are also some prerequisites, and if you complete those prerequisites, these sessions will be much more easier for you to understand. Now, what are those prerequisites? Let's talk about them quickly. The first one is the Trading Essentials course. Now, if you have a very good trading background, you have been trading for a number of years, I'll say this can be optional for you, though I would highly recommend everyone to go through the Trading Essentials course first. Now, how do you get access to the Trading Essentials course? Very simple. Once you're on our website, under services, you'll be able to find the option that says courses. Click on it. And here you can see the very first course is the Trading Essentials course. Click on this and you'll find that the course is available in 2 languages, English as well as in Hindi. So whatever language you're comfortable with, just click on the button and it will straight away take you to the course playlist. The lessons are lined up for you in a very systematic way. You have lesson 1, lesson 2, lesson 3. So just go through all the lessons, and that basically covers the Trading Essentials course. Again, best part, no registration required, no sign up required. You simply click on this button and you have immediate access to the course content. Now, once you are done with the Trading Essentials course, the next step is to learn the demand supply trading methodology. So how do you get access to the demand supply course? Again, under services, you'll click on courses, and you can see after Trading Essentials, the next step is your your demand supply trading course. Click on this, and here also you can see the courses available in English as well as in Hindi. Now, once you go through these lessons, you basically learn the methodology, like I said, theoretically. Now, what we have also done for you is that all these practical sessions that I take, we also keep an archive of it, so that if you want to watch more number of practical sessions, you can always watch the previously recorded practical sessions. So here you have the option for practical sessions. You can click on it, and the practical sessions are also available in both languages, English as well as in Hindi. So once you click on it, you will have access to the recordings of the previous session. And like I said, anyhow, every weekend I do a live session as well, wherein you can join live for the practical sessions as well. All right, so that takes care of the first two prerequisites. Now, during these live sessions, you will also see that I use certain documents which help us plan trades in a very mechanical and rule-based way, which are the rule book and the flow chart. So how do you get access to these documents? Again, very simple. On our website, under services, go to download section. And here you can see the very first one is the rule book, and the second one is the flow chart. So this is your rule book, and this is your flowchart. Now, how do we use these documents? You will see that during these practical sessions. So that basically covers the prerequisites. And now that we are done with all the prerequisites, we can start with our analysis for today. Now, whatever we analyzed in the past, whatever was triggered has already been reviewed. This week, no new trades, they got triggered. So we don't have anything which is pending for review. We can straight away start with our analysis for today. Now, whenever we start planning trades, or whenever we start with trading, I always say that trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based? I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched that video, the link is available in the description. Do ensure that you watch that video, understand the process, follow that process. You might have to do it maybe twice, maybe thrice, but the more you practice that process, the more you'll start becoming a rule-based trader versus an emotion-based trader, which is very, very important. So yes, because we need to be very mechanical and rule-based, what we need to do is we have to create a trade plan for us. Now, the problem is when you are starting as a fresher, or even when you're starting learning a new methodology, it's not very easy to create a trade plan from day one. And the reason for that is that unless and until you have a very good experience of a particular methodology, it's not easy to convert it into a trade plan. So this is what I've already done for you. These two documents, which is the trade plan steps, and the rule book, helps you plan trades in a very mechanical and rule-based way. It's more like you have a ready-made trade plan for you. But yes, with time, with experience, if you want to make some modifications to it, because every trader has a different personality style, you can definitely tweak it based on your personality style. But at least you do have a starting point using which you can start planning your trades early on as a very mechanical and rule-based trader. So what is your step number one whenever you start planning your trade? Your step one is to define your trade purpose. And what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when we are talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why am I starting with my trade purpose as my very first step? And the reason for that is that when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge is that out of so many time frames which are available, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We go again with a very logical approach, and that logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income is a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, like if you take the example of the India NSE market, which is not a 24-hour market, I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24 hours market, we have that added gap risk. And initially, when we are learning a new methodology, it is always advisable to be as conservative as possible. So that is why my recommendation to all of you is that initially your RLs and dailies will be strictly intraday trades. You'll not keep them as overnight trades and take that unnecessary overnight gap risk. Now, when it comes to weeklies and monthlies, anyhow, we are not expecting that we'll be getting the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions, but that does not mean that for weekly, monthlies, we cannot have gap against us. It can still happen, but since we are leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight trades, that can definitely be done. So my step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rulebook, I'll get to know what time frames I should be using. So if you go to page number 28 on the rulebook, we start with the topic which is multiple time frame analysis. Because demand supply methodology is not based on single time frame, demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different purposes of trades? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now, mind it, this table, which is on page number 31, is specifically for the NSE market because this market is only open for about 6 hours and 15 minutes. But when you're trading markets which are open for longer durations, like you have your commodities, you have your Forex, maybe you're trading some international markets, maybe the cryptocurrencies, then you can refer to the table which is on page number 32. But since I'll be taking examples from the NSE, I'll be referring to this table. Now, as we talked about that, let's assume I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate used for trend analysis. Lower time frame will be daily. That is where we get our SCTS from. Just give me a second, please. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, and now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if we again take the example of NSE, on NSE we have over 2,000 plus companies listed. So humanly not possible that every day I sit and analyze 2,000 companies. So what I need to do next is I need to have a process in place which can help me get a smaller list out of a very big list. Like in this example, we have a list of 2,000 plus companies. So I need a process to get a smaller list out of these 2,000 companies. So how do we do that? For this, we use certain computer programs which are called as scanners or screeners. And if you do a Google search, you'll be able to find a number of free scanner screeners which can help you shortlist symbols based on either conventional technical analysis or fundamental analysis. But the problem is that all these scanner screeners are either, like I said, based on fundamental or based on conventional. There were no scanner screeners based on demand supply methodology. So that is where we also created two custom built tools. One is called as the demand supply zone alerts. The other one is called as the demand supply screener. And these two scanners are purely based on demand supply zones. Now, how do they work? You can simply click on them and you can visit our product pages. The walkthrough videos are available. You can watch those walkthrough videos to understand them better. Otherwise, I'll also show you how you can, watch those videos once you're on our website. So once you're on our website, under services, you have TradingView indicators. Click on it. And you can see the second one is the alerts. The third one is the screener. You can click on them. You can visit the product pages. The link to the walkthrough videos are available. You can go through those walkthrough videos to understand what these scanner screeners are. So yes, second step is to get a smaller list. Now, how you get that small list is completely your choice. You have a lot of free scanner screeners available online. If you want something which is purely based on demand and supply, then you have these two tools available to you. The process can also be as simple as, because I need a smaller list, maybe I just want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that list. But definitely the more the process is in sync with demand supply, the easier it will be for you to find opportunities. And also remember, irrespective what method you're using for getting a smaller list, whatever scanner screeners you use, they do not provide ready-made opportunities for you, right? So just because something is getting shortlisted by a scanner or a screener does not mean you can blindly buy it or blindly sell it. The job of the scanner screener is not to give you ready-made opportunities. The job is to give you a smaller list which is in sync with whatever concept you want to use for shortlisting those symbols. Now, once you have that list of symbols, you will have to analyze them manually and see which one matches with your trade plan. And the one that matches with your trade plan will be your opportunity. The one which doesn't match with your trade plan, you simply skip it. So let's assume we got a list of symbols, whatever process you applied, now you have a list of symbols with you. And the very first symbol in that list is, let's assume, ABC. So what we need to do now is on ABC, we need to go to the lower time frame. So the question is, what is my lower time frame? And we got the answer from our step number 1. That is, as a monthly income trader, my lower time frame was daily. So we'll go to the daily chart on the lower time, which is the lower time frame. And there we need to identify a zone. Now, again, what happens is when you start learning demand supply methodology initially, it's not very easy to identify demand supply zones. And even when you start identifying these demand supply zones, it takes a while for our eyes to get trained to identify quality areas versus any demand zone or any supply zone. So to overcome this challenge, we also have a indicator which is called as the demand supply zone indicator, which automatically identifies and plots the demand supply zones for you based on whatever quality settings you'll keep in that indicator. And the best part is that we do offer a 100% free 7 days trial of the indicator. So in case you've still not tried out the indicator, you can try it for free for 7 days. Now, how do you get access to the free trial? Very simple. Once you come to our website under services, go to the TradingView indicator page. Just give me a second. Right, so you'll go to the TradingView indicator page. Here you can see the very first one is the demand supply zone indicator. Click on it. Now, once you click on it, you can see that you have the option for 7 days free trial. Click on this. And the direct link is also available in the description, by the way. Right, and once you're on this page, you just have to fill up this very short form, which will take you probably less than 30 seconds. The first one is, how did you hear about us? You just have to choose the correct option, your full name, your email address, and your TradingView username. In case you don't have a TradingView account, what you can do is you can click here and create a free TradingView account, and then you can provide your TradingView username. In case you already have a TradingView account, you can click here to visit your TradingView profile. Identify your TradingView username and provide it in this column. Now, very, very important that when you're providing your TradingView username, always double check that you're providing it correctly, because if you provide an incorrect TradingView username, it will not get activated for you. It will get activated for someone else. So yes, once you have filled all the information, you simply submit the form. And once the form is submitted, within 24 hours, it will get activated for you. And once it is activated, you'll receive a notification on TradingView itself that now you have access to the indicator, and then you can try it for free until the expiry of your trial. Now, let's get back to the next step. So yes, step 3 was to identify a zone, and because now everyone has that opportunity that you can try the indicator for free for 7 days, whatever analysis we'll do, in fact, whatever analysis we have been doing in the past has been purely based on the indicator, and that helps you understand the advantages of the indicator and how it helps you plan trades very quickly and mechanically. So if I go to the chart, you can see here we don't see any zones which are getting drawn by the indicator. And the reason for that is that the default setting of the indicator is to identify quality zones. So if there are no quality zones, nothing will get marked on the chart. But that does not mean there are no zones. If we zoom out, now you'll be able to see some zones which can be somewhere in the past. And like I said, as of now, the settings is that I just want to see quality zones. So this is where we have our quality zones. Now, if I just change the indicator settings that I want all demand supply zones, now you will see we have many more structures of demand and supply. So again, based on your personality style, at the end of the day, you have to choose what kind of zones you would like to utilize for planning your trades. But yes, there can be a lot of zones. It's our choice whether we want to go for all zones or quality zones. I always prefer quality zones, so I'll always keep it something like this. Now, another thing which I'll add here is that this is what I use as my default settings, and that is what has been set in the indicator. But I can see that we do have a gap here. So there probably might be a zone because of a gap, which to me looks like we do have a drop-based rally structure. Now in the indicator, we have that option. Can you see identify overnight gap zones? So if I check mark this, you will see it will also identify the zones which are because of the gaps. Now, since my eyes are trained to identify these structures which are based on gaps, I generally keep it disabled. And the other reason why I also keep it disabled is because I'm pretty sure all of you would understand that whenever a symbol opens, just give me a second. Specifically in the India NSE market, we always have a gap up or a gap down. Just a second. All right, I apologize. I wanted to have some water. Anyways, so like I said, if you're trading markets which are not 24-hour markets, so if I take the example of the NSA India, I'm pretty sure all of you would have experienced that almost every other day. Every symbol gaps up or gaps down. It might be a very small gap, maybe 5 paise, 10 paise, but definitely we do have a gap up or a gap down. So if I keep this option enabled, it will throw a lot of zones at me because of these small little gaps. So that is the reason I personally prefer to keep it disabled. But yes, if you want to check zones based on the gap, you can always enable it. If you want to enable it for some time just to verify whether you have a zone or not, you can even do that. So that is what I'm doing as of now. Can you see when I enable it, we can see we do have this drop base and the gap up, which is a drop based rally structure. And since we know we have a gap here and the indicator is also identifying that zone for us, we can mark it as a demand area for us. So let's change this to demand. So yes, we do have a zone, which is this drop base rally. Again, I'll show you if I enable the zones based on gaps. So you can see we came down, we paused for a while. From here, we had a gap up, and that is what the indicator is marking as a drop base rally zone for us. All right, so let's move forward. So yes, our step number 3 was to identify a zone. Do we have a zone available? The answer is yes, we do have a zone available. Now, once you have identified the zone, does not mean you trade it blindly. And the next step is to qualify it. And for qualification, we have a two-step process. In step one, we'll qualify it based on certain conditions. And in step two, we'll qualify it based on the booster scoring. So the first one is, can it be a case of level on top of level? Let's verify that. Now, how do we verify it? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be completely inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And here you can see we do have an intermediate time frame zone, which is right here. And what I'll also do is I'll change the color of the intermediate time frame zone so that we can differentiate between the two. So the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So if I again go back to the lower time frame, you can see we have your intermediate, which is the one in pink. We have the lower time frame, which is the one in green. And while I was changing it to, identify overnight gap zones, you can also see we also have a zone inside of it. And if I enable all demand supply structures, you can also see we also have this as a zone available to us. So yes, if you look into it, you can see that inside of this intermediate time frame zone, we do have multiple zones, which is this one and this one. So is my intermediate time frame zone getting divided into multiple zones on the lower time frame? The answer is yes. Which definitely makes it as a case of level on top of level. And what we should be doing in case of level on top of level, by default, we should be using the lowest zone. And that is what we are already doing in this case. So we don't have to make any shift because we are already using the lowest zone, but definitely it is a case of level on top of level. So we have looked at the very first condition, level on top of level is definitely applicable, but we have also verified no modification is required because we are already leaning against the lower zone in case of demand. Now, is the zone because of a gap? The answer is yes. Now, whenever you are planning trades, which is because of a gap, you also have to ensure that the zone gets qualified based on the gap rules. Now, what are the gap rules? Again, if I go to the rule book, you will see that the rules for the gap is, just give me a second again. Right, so the rules for the gap is one, that whenever you're using your demand supply, whenever you're using gaps as your demand and supply zones, first and foremost, it has to be an overnight gap and it also has to be an open gap. Now, if I go back to the chart and if I again enable the option which is identify overnight gap zones, so just to show you the difference between a zone which is open, so you can see here. So again, let's understand what is an open gap. In fact, let me do this. This will make the chart neat and help you understand. So now let's assume, because this is a green color candle, let's assume we closed at 100 rupees, right? And what happened is the next day we gapped up, and let's assume this gap was at 102. So from 100, we gapped up to 102, which means we had a 2 rupee gap. Now, unless and until prices, they come back to this 100 rupee, this will remain as an open gap. Just give me a second again. Right, so apologize. Today I have a bad throat, so I apologize for that. But yes, coming back to, so you can see we do have an open gap. So unless and until prices will come back to 100, this will remain as an open gap. So here you can see we definitely went a little over. So maybe we went to 101.50, but we still have an open gap from 100 to 101.50. So unless and until we come back to this closing price, this will remain as an open gap. And why do we have to look for open gaps? The reason for that is if the gap is already filled, it is already a tested zone, right? If it is an open gap, it is still fresh for us. So that is why the condition is it has to be an overnight gap and an open gap. Open implies it will always be fresh. Next, it has to be a pro gap. Now, how do we verify if a gap is a pro gap or a novice gap? So the definition of a pro gap is a gap in the opposite direction of the price and has to be checked on at least the daily, or I'll say maybe above. So if you look here, for quite a while, we have been moving down and then we got a gap up, which definitely qualifies this as a pro gap because the dominant direction was we have been moving down. In fact, if I go to the weekly, you can see it much more clearly that we have been moving down. So probably we were at some cheaper prices and somebody wanted to buy a bigger quantity, and the only reason they can do that is by buying a little expensive. So that shows us that during the pre-market, somebody was willing to buy a little expensive, something which has already been beaten down, maybe because they wanted to have a bigger fill, which definitely qualifies this as a pro gap. So my condition 1, condition 2, definitely applicable. And the last one is if a symbol is making all-time highs or all-time lows, which is not applicable to this one because it is not making all-time highs or lows. So the only the above two conditions were applicable, and based on those conditions, it is definitely qualified. Did not get disqualified due to any of these conditions. Now, if we talk about pivot and non-authenticity, it is definitely a drop-based rally structure. So to drop-based rally, we always apply the pivot and non-authentic rules, but there are some exceptions, and those exceptions are, let's move down. So here you can see that in case of a pro gap, you don't have to apply the rules of pivot and non-authenticity. So since we know we have a pro gap, we don't have to apply the rules of pivot and non-authentic. And even for cases of level on top of level, this was also a case of level on top of level. So in both these scenarios, pivot non-authentic rules can be skipped, so they will not be applicable, and it is not unstable equilibrium. So after applying all the applicable rules, is the zone qualified? The answer is yes, because it did not get disqualified due to any of these conditions. And the next step is we have to now apply the boosters, which is the quality and the probability boosters. So just give me a second again. I need to have a little bit of water again. Perfect. So yes, we'll apply the boosters now. So just give me a second. We'll go back to the chart. And let's start applying the boosters. The very first one is freshness. This is definitely a fresh zone for us. Gets a score of 3. In fact, let me also do this. Let me draw the entry, the stop loss, and back to the entry. So definitely a fresh zone gets a score of 3. Talking about strength, we have a pro gap which gets a score of 2. Time at the zone, we only have one candle, which is again a score of 2. Reward to risk ratio will take as an assumption. Now talking about location, if I go to my higher time frame, which is monthly, you can see that this zone is located inside of my monthly zone, which puts me at the best location. So best location gets a score of 2. A trend becomes irrelevant because it doesn't matter whether we are in an uptrend, downtrend, or sideways. At best location, all trends can be traded with a score of 1. So being at the best location also gives you the advantage that trend becomes irrelevant. Otherwise, once you go to the intermediate time frame zone, the indicator also automatically does the zone violation analysis for you. So it is telling you that if you look in the past, we have had violation of 2 supply areas, which is a rally-based drop and a drop-based drop. So here you can see we had this rally-based drop structure. So that's the violation of the first supply zone. And then we have this drop-based drop. So since 2 supply zones have been violated, that technically puts us in a uptrend, right? So that is what we define as an uptrend, because if we are in an uptrend, the supplies will get violated and the demands will get respected. That is what we'll be seeing most of the times, and that is the only way prices can make new highs. So yes, we are by default in an uptrend as of now. Now, talking about move from the zone, we need at least a 4:1 move, which has already happened, gets a score of 2. It is a case of level on top of level. It is also a coinciding level, and the last one is trap. So if I take a horizontal line, and if you start pushing it up, I will zoom out. So you can see as we start pushing it up, somewhere around here, right? So you can see this has beautifully acted like resistance, beautifully acted like support, If I bring in a little bit more history here also, you can see it acted like resistance, acting like support, almost acting like support, acting like resistance, acting like resistance. So we do have a pretty clean area of support and resistance, which is sitting above our zone. So what is going to happen? People who believe in support and resistance, as support, they will be buying here, and their stop losses will be placed below this area, and these stop losses will be your sell orders. And similarly, if we get a breakout, then people who believe in breakout will also start selling. So we understand that by the time we reach into this area of demand, we'll have a lot of selling coming into the market because of the stop losses, because of these breakout traders. And what are these people doing? They are making two novice mistakes. Mistake number one, they will be selling after the decline in price, which means they'll be selling at a cheaper price. And that too in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only reason for prices to move up. So definitely that possibility is there, that this can work like a trap, for which we'll give it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 with the assumption of reward to risk ratio, and 8 out of 8 for the probability. So this makes it as a high quality, high probability setup, and high quality, high probability can be traded as type 1 trades. Now, very, very important. So this is something I have seen many times, because this zone has the highest score, which is 10 out of 10, 8 out of 8. At times we take it as an assumption. Just give me a second again. And that since this is the highest quality and the highest probability score, this is going to be a sure shot winning trade, but that's not the case, right? So this only talks about quality and probability. The score can be the highest score for quality, the score can be the highest score for probability, but it can still be a stopped out trade. So always remember, just because you have a very good score does not mean that this will be a sure shot profitable trade. This can still be a stopped out trade, and that is why the next step is we need to be ready for the worst case scenario, for which we'll do a position size calculation, which is part of the risk management, so that in case the trade does not go in our favor, it goes against us, we should not be losing more than what our trade plan allows us to lose. Now, whenever the prices are back, we'll have to re-verify before placing our order. And the reason behind that is because the markets are not static, markets are dynamic, conditions are changing almost every other second. So before you enter a trade, the way we qualified it as of now, you just quickly recheck this, that does it still qualify based on my trade plan? If the answer is yes, you place your order based on the entry type. In this case, it's a type 1 trade. And once your order has been executed, the last step is your trade management, where what we do is step 1, 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trading stop loss. Just give me a second again, please. I really apologize. I have a bad throat today, so I'll have to, keep pausing in between just to hydrate a little bit. So just give me a sec. So this is how you plan trades, very mechanically, very rule-based, and that takes care of today's practical example. Now, before we move ahead with the questions, queries I have in the chat box, let me add few things. One, if these sessions are helping you with your trades, planning your trades, managing your trades, making you a better trader, then do like the video. If you're not subscribed to my channel, do subscribe. And if you are on some trading groups, do share the link to my course content, links to these live session, link to the free trial of the demand and supply zone indicator, so that more and more people can take advantage of all these free resources which are available. I know a lot of people are struggling with trading, and the more we help the community, the better it is going to be for everyone. So yes, again, do share it with your trading groups, or if you have any friends or family members who are into trading, share with them as well. Now, again, before I take the Q&As, which we have in the chat box, let me also add that one feedback which we were getting from you people was that during the Q&As which we have in the YouTube live session, you cannot share your analysis. So what if you want to share your analysis with me, or what if you don't want to ask your questions publicly, you want to ask your questions privately? So for that, once you come to our website, we have an option which is called as one-to-one session. So once you click on one-to-one, it will take you to this page. This is where you can schedule a one-to-one appointment with me. Two options are available. One is a voice call. So if you feel you can just have a voice call and ask your questions on the phone, yes, you can go for a voice call. Second is online meeting. So if you feel that you want to share your screen, you want to share your analysis, that is where you can also schedule an online meeting with me, right? So that option is definitely there now in case you don't want to ask your questions publicly, or in case you wanted to share your screen with me. All right, so let's see what do we have in the chat box today. If I entered MIT, WIT, DIT, HIT, means what's my target or stop loss or break even time frame? So again, when it comes to what time frames you'll be using, you can always refer to page number 31 or 32, I guess. Yes, if you're trading the NSE market, you can refer to page number 31. If your markets are open for longer durations, these will be the time frames. And if you're talking about, let's say, what will be my target stop loss, so you can see your stop loss entry target and your position size. They always come from your lower time frame, and these would be your time frames depending upon what markets you are trading, right? So again, if you're trading markets which are open for longer durations, these would be the time frames for different purposes of trades. If you're trading the NSE markets, then these would be the time frames for different purposes of trades, right? So it is available in the rule book. So how do you identify this script out of 2000 plus NSE symbols? So I have talked about this in the past as well, that if you go through all the recordings, right? Currently, we have a recording of almost 1.5 years. So all the examples that I share with you, I shortlist them by using the demand supply screener, right? So like I talked about, we have two tools available to you. One is the demand supply alerts, and the other one is the screener. So I use the screener to shortlist these symbols. All right, so that answers the queries that we had in the chat box today, and that also brings us to the end of today's session. Thank you everyone for joining it. Okay, SS says your sessions are too much helpful, sir. Okay, happy to know that these sessions are helping you. But again, I'll add that yes, I am trying my best to make trading as simple as possible for you people, but at the end of the day, it has to be your effort, because you'll have to practice it. The more you practice it, the better your results will start getting, and the easier it will become for you to plan trades. So happy to know that it is helping you, but again, practice it. The more you practice, the better you will get with this, and the better will be your results eventually. All right, so again, thank you everyone for joining in. I'll be seeing you next on the next weekend. Until then, trade safe, enjoy your Sunday. Take care. Bye-bye.